Hi, this is Drew Tignanelli. This is our March update. A lot going on, Mike. And normally I like to be kind of jovial in these, but there are a lot of our clients that are concerned about what's going on. So this is time to be, serious and give them a serious understanding of our take of what's going on in the markets and so forth. A lot of disrupting things in the world with President Putin has invaded Ukraine as of the taping of this. Who
Right.
knows what'll be going on by the time we get this into the hands of our clients on March 1st, 2nd, 3rd, whatever.
Yeah, something like that.
But, you have some interesting statistics about just from a general point of view. How much does
Right.
Ukraine and Russia impact the world economies?
Yeah, I mean, not to, as Chris said yesterday in his market update, not to overlook the human tragedy that certainly has unfolded. But, we kind of say this all the time, and it's become a broken record that there's a lot of hype when you turn on the news. There's a lot of things they want to communicate to make sure that you stay watching and stay glued to them. But I thought that probably the best way to approach it is to go over, well, where are some of the real impacts of the Russian conflict and how this could affect world economies. And the first one that's on everybody's tip of their tongue is crude oil. So I have some good news for us here in the US. Russia's share of the world crude oil supply is only about 10%. Good news for us, but not for our European friends, because for Europe, it makes up about a third of their supply of oil. Now, what about the price of oil? So one thing to know that maybe not everyone does is there's two main types of oil, Brent oil and West Texas Intermediate oil. Brent oil is the type of oil that is drilled or processed or taken by Russia. It's gotten up to about $100 a barrel in the last day or so. And our West Texas Intermediate's about $92 a barrel. So one of the things we look at, and I think Drew will explain a term around this, is what are the futures market saying? What is the economy thinking what will happen in the future? And right now, futures show that beginning in about May 2022, oil prices begin to fall, and they continue falling all the way through December, down to around $80 a barrel at the moment.
Right.
And you said there was a term that you used.
So first, our clients need to understand that the futures market gives businesses the ability to buy supply of oil that they need all the way out to 2023, saying, I think, prices could go higher, or the producers of oil can say, I know I'm going to produce so much oil, I'd rather lock in the prices today. So this is what the futures market does. And normally the price of oil being bought right now is X. And then every month it's X plus Y plus Z plus, it's a little higher, right? But when it goes like this and the price of oil is here, and this is true for any commodity, the price is here, and then all of a sudden over the next 12 months or so, it's lower. That's called backwardation. Now, why is it always a little higher going out? And the answer is because what's normally going to be done is they're going to produce the oil and store it until they sell it, and it costs money to store things. So there's a cost of what it's going to take to produce that and hold it until the time to actually deliver it. So that's why it's always typically a little higher. But when you go into this backwardation, where the price today is significantly higher than the price tomorrow, that means that the market believes that the supply of oil is going to be greatly larger in the future, and that there's a disruption going on right now compared to the supply and demand, and prices are high, sort of artificially. Now, backwardation normally is a very good predictive tool. So the markets are probably correct, but there have been times where backwardation didn't prove to be correct, but it's not the norm. The norm is that 12 months from now, it will be lower.
Right. So one other significantly lesser than the crude oil is palladium is a metal that's used in catalytic converters and certain other things. And Russia does supply about 43% of that. But as Drew and I researched before shooting the video, platinum can be a substitute in some cases. So hopefully that won't have much of an effect. But One of the other big numbers that we've been looking at, and we always look at and talk about, is the 3-month Treasury bill. It's what we refer to as the risk-free rate. And it has had a change. So if you go back to January, the risk-free rate, or the 3-month Treasury, was sitting about 0.03. And as of yesterday, of the day we shoot this, which was yesterday was February 23rd, it had risen to 0.36%. Why is that important?
Well, it's just showing that the Fed's likely to raise rates, and that's an important thing to understand. But the good news is that Russia is probably going to hold back the hand of the Fed from being too aggressive. Some people are going to argue that that's wrong, but history always shows that when the Fed is temperate and when they're slow to raise rates in these types of situations, that the market can do quite well during those. It's when the Fed comes in and does shock and awe. Thank you. I couldn't get that out. Shock and awe, where they try to raise interest rates to say, no, we are not going to accept inflation, period, and we're going to do whatever. That's when the markets tend to react negatively to those kind of things. I think one of the reasons the market recovered yesterday is because that they see this as holding the hand of the Fed back to some degree, that they're still going to raise rates, but they're going to raise them slowly instead of maybe fast as they were potentially thinking about.
Now, as we talk about rates, one of the other things we often talk about is the yield curve. The yield curve has had in the history a predictive nature to it when it gets inverted, which means that the long-term rates are lower than the current rates. But at the moment, we have a pretty flat yield curve where as you go from 3 months to 10 years, there's a very, very flat but gradual increase. So speaking of the rates, why does the Fed want to raise rates? Well, it's to reduce inflation. As of January 2022, U.S. inflation has come up to about 7.5%. And, that's rattling to the Federal Reserve. Their previous, goal was 2%. Who knows if after we go through this, they change what their goal is. But what a recent study found that 4 out of 5 Americans don't understand fully the relationship between interest rates and inflation. And I don't think we have enough time here to give you a full lesson, but why don't you just speak on that for...
Well, if the value of $1 is going to be 95 cents a year from now, and you've given somebody $1, you've lent somebody $1, you're going to want your dollar back plus interest on it. So therefore, if you expect inflation to be 5, you want 6 or 7, and depending on how many years you're going to lend that money to and what your prediction is for inflation in the future. Now, here's a funny thing. The funny thing is that right now, big investors are lending billions and billions and trillions, technically, of dollars to different corporations in the United States government for 2.1%. Okay, 30 years, 2.1%. Why is that not spiking to 6, 7, 8%? These are not dumb people. And the answer is, I don't think a lot of the large investors believe that the inflation numbers are long-term. You had a dramatic cutback in the supply chain. You had a dramatic stimulus from the federal government into the hands of people. They spent like there was no tomorrow that money, which then continued to eat what diminishing supply was out there, and the global supply chain had been disrupted. But now you're seeing this loosen up.
Yep.
You're starting to see this loosen up, and it's not dramatically loosening up, but you're starting to see it loosen up. And that's, I believe, why investors are sitting back saying, look, I'm not, we're not going to believe that rates are going to actually go to 7% right now.
Right.
So we don't believe it either. We're right now saying that I think the economy's very good, and you're seeing this pandemic go into the rearview mirror to some degree. Okay. And let's hope that there's nothing else coming, but it looks like it's going into the rearview mirror. And if it is, and you consider the pent up demand that's still out there, and you can see there's pent up demand because people are still spending despite the inflation, despite all the things in the world, people are still spending. House prices are still going up. And here's the fascinating thing, Mike, supply of houses is still dramatically lower. There is no increase in the supply of houses despite the rise in the prices. It normally, when you get rises in prices, supply would go with it. People would start putting their houses up for sale like there's no tomorrow, but they're not. Why? Because there's nowhere else to go. And that's why there's no increased supply. We had a dramatic curtailing of the housing, of the house building between 2008 and just about a couple of years ago. We just started to really meet the demand of new housing starts in the last year or two. But for 8 or 9 years, that was dramatically curtailed because of the collapse in 2008 and 9. And that's why house prices are going up. It's not, you know, people keep telling me bubble, bubble, bubble. They're saying a bubble because they're seeing prices go up. And when they see prices go up, they reflect back to 2008 and said, wow, that was a bubble. So this is a bubble. No, this is a supply constraint. And that's why prices are going up. What we need is new housing starts. We need more and more and more new housing starts, and that will start relieving the pressure on the price of houses. But that's why I believe this economy wants to explode on the upside, yet there are, you know, unpredictable things, and markets don't like unpredictable things.
Right. Well, I'm going to circle back to one thing that I thought was important to get in here, which is what is the expectation for what the Feds will do with rates? Because that's going to, you know, that can have an effect on housing, and it can have an effect on a lot of things. And the best information we have is the most recent argument made by Federal Reserve Governor Waller is that in hopes that they would raise it by 0.5% sometime after mid-year. So that just tells you how kind of dovish they are being.
Yeah, and that's why I think markets like that. But you know, you got unpredictable things. President Putin is an unpredictable person, and that's what's creating fear. And the media doesn't help it any either. You know.
Yep. Now, but on that topic, so the last item we have as far as how this could affect us in our markets is a warning. This is a warning we've given before, but it's even more important now than ever, is cybersecurity. So one of the things we hope all of our clients do is be increasingly vigilant on ensuring that they are not clicking on emails that they're not sure where they came from. They're looking at where the email came from and making sure that when you highlight over it, whatever it says is actually the email address it comes from. So highlighting over, putting the cursor over the email address but not clicking on it can show you that, oh, it's actually a different URL. There has been incidental evidence. A number of the staff here have said they've noticed an incredible uptick in the number of those fraudulent emails that we receive. So we would urge you all to be increasingly diligent. Dual
factor authentication, notifications on all of your accounts, very good things to do, good passwords and so forth. Let's end on just saying that we're in tax season, Mike, and people are filing their tax return, and occasionally, Mike, we see some good things where we file tax return and a week or two later the client calls us up and says, gosh, I already got my refund. You know, we're also seeing situations where, you know, the IRS backlog from 2020 and 2019's tax returns is still not relieved.
Right.
I think you're sitting
still waiting on my return, my refund.
And you just found out that they can't tell you now what
it's gone from processing to we cannot tell you the status.
Right. You know? Well, you are Irish. You know?
Well, one of the things that you brought up just this morning is paper checks. Right.
Oh, you know, gosh, you know, please. I know I don't like the IRS going into my checking account either, but I will allow them to direct debit. Why? Because they can take anything out of your checking account they want to right now. And if I send a paper check to them for money I owe to the state of Maryland or to the federal government and it doesn't get there, it's
on you.
It's on me. And you say, well, I'll send it certified. And no, that doesn't work because you can't certify what was in that envelope. Or, you say, well, I'll send it UPS and I'll mark on there, this is my refund check. Well, you can't prove that the check was in there, and there is no way. But when you pay it electronically, you get a confirmation immediately that the money was transferred and was fully received by the Department of Treasury. Debit, direct debit. I know you don't like it. I don't like it, but this is the way to go. Direct debit. And you like it to direct deposit. Why don't you like direct debit? And we always wait until the last moment to send the check. So if we can wait until April 15th midnight to pop that check out, that's when the
Pop
computer
that debit out.
That debit out, right? That debit out. It's technically an electronic check, actually,
Okay.
believe it or not. It's an ACH transfer, which acts the same way as giving them a paper check. So anyway, anything else?
No, I think we've run our time.
Well, anyway, we're just as concerned as you are. We never like these down periods, but as we always say, economics says carte blanche. If you want a higher rate of return than the free safe rate of return, which you just said was
Up to 0.36.
0.036, or
It was 0.03. Now it's up to 0.36, which it's nothing.
0.36, which is nothing. If you want a higher rate of return, then volatility must be present. And if there isn't volatility, the best you're going to get is 0.36, 0.5 with no volatility. And you will absolutely guarantee that you'll be devastated long-term by going with that lower rate of return. Whereas if you accept some volatility, there's a much greater than, reasonable chance that the world economies are going to continue to grow, and therefore stocks in the long run are going to work out in the best, the best rate of return. And these are the companies that price inflation into goods, right?
Right.
So it makes sense that they're going to be the true inflation hedges if there is inflation.
Correct.
Anyway, it's Drew Tignanelli saying, God bless.